So two of the most common legal structures for businesses are what's called the sole proprietorship and the corporation. And both of these legal structures can make a lot of sense depending on the situation, depending on the nature of the business, depending on the goals of the owners, but they need to be treated differently, especially from a financial perspective. So in creating a corporation, even if you just create it yourself and you're the only owner, it's just you operating in the business, you still have to treat it differently than a sole proprietorship, because creating a corporation is almost like creating a new human. It's creating a separate legal entity. Not quite the same as a human, but it's treated quite differently. So for example, a corporation has its own tax return separate from the owner, and the corporation stays alive even if the owner and the creator of the corporation are no longer alive. So that's not the case with a proprietorship business. The owner of a sole proprietorship only has to file one tax return that includes their personal tax stuff plus their business activity. And if the owner of the proprietorship passes away, the business no longer exists. So there are a lot of differences, and I've covered those in other videos. But in this video, I just wanted to talk about how you treat those from a financial perspective, particularly with reimbursement if the owner of the business is making purchases. So for example, if you own a sole proprietorship where there's no real legal separation between the business and the owner of the business, then you don't have to be as careful with the financials. It's okay to make purchases for the business on your personal credit card, your personal line of credit, your personal bank account. Generally, I would recommend having separate bank accounts for the business, but it's okay to do this. For a proprietorship, the main thing is that you are reporting all the money coming in and the money going out for business purposes, and that you're tracking that money coming in and going out, all the expenses and revenues, and you're putting those on your personal tax return for business activities. But there's no need to really reimburse yourself. Like if you have a business checking account and you made a purchase for, let's say like a new office table, desk or something like that on your personal credit card, the checking account doesn't necessarily need to write you a check to cover the expense you paid for on your personal credit card. That doesn't matter much in a sole proprietorship, as long as you've tracked it for your records and for your income tax purposes. Whereas with a corporation, a different dynamic is created where, again, it's kind of like having a separate human almost, where if you are the owner of the corporation and you make a purchase for the corporation using your personal credit card, then it's not just about tracking that. You should also be reimbursing yourself through the corporation's bank account. So in that example that you bought like a new table for your office or a new desk or something using your personal credit card, then not only should you be keeping the receipts and tracking that, but the corporation should write a check out to you, or could be e-transfer made out to you personally from the corporation, and then the corporation can claim that expense. So there is that separation there. Or if you're having like ongoing expenses, like maybe you're paying for a subscription for some type of software out of your personal credit card, then the corporation should really be claiming that as an expense, especially if it's actually being used for the corporation, and they should be reimbursing you. So again, just kind of think of it like a separate person. If you're making purchases for that other person, they should be paying you back for it, and you should be giving them the receipt so that they can have it for their records if they need to make a return for their income taxes, things like that. So with that, a corporation definitely is more work, especially from an administrative standpoint, but in a lot of cases, it still can be beneficial because there are some advantages to incorporating. So if you do incorporate, just make sure you're doing that properly, managing your financials properly, keeping it as separate as you can from your personal expenses and personal financials, and reimbursing yourself appropriately if you are making purchases for the corporation with your personal bank accounts or credit cards or whatever it is. So hopefully the video was helpful. If so, please click like and feel free to check out all the other videos on my channel that cover business management and business startup topics. And if you're looking to work with a business consultant that can really help you with all things business startup and business management, feel free to reach out. I do offer a free initial 1-hour consultation that can be booked with the link in the description of the video.